Alright guys, welcome to module 1.2. This is our second video in our lesson 1 video series on price action basics. So today we're going to build off of the previous module and we're going to talk about major levels of reaction and major or minor levels of failure. So in the last module we talked about market structure. We talked about price making our highs and our lows and how that gave us clues to whether we're in an uptrend or a downtrend. But let's talk about why does it make those higher highs, those lower highs, lower lows, higher lows? Why is price reacting at those levels? And how can we kind of look ahead to see if we can spot a trend in price and catch those points of reaction? Okay. Now, one thing that I'm going to put out right off the bat is that you're not going to catch the full move every time. You're not going to catch movements at the very peak of a reversal down to the very bottom of the movement. But what we can look for is for areas where price will have these reactions, and then once we see movement start to happen, we get in on that trade and try and catch the middle, just the meat of the bone, just the chunk, the biggest chunk of that movement, and that's what we want to be happy with. We don't want to try and catch the entire movement, but we want to catch the bulk of it, okay, the middle. That's what our aim is. So let's talk about points of reaction and points of failure. And this is going to build off of the basic idea of support and resistance. So if you need a refresher course on support and resistance, what that is, go back and watch the support and resistance video module in the free price action series. But we're basically talking about levels where price cannot get above or below. So levels that price can't get any further below is our support, is our floor, and levels that price can't get any higher is our resistance, okay, our ceiling. So we have two types of levels when we talk about support and resistance. We have our points of reaction. These are our major levels. Okay, we're talking about levels where institutional money has stepped in and reversed price. These are our big moves. Okay, these are our daily, our weekly, our monthly, and even our yearly highs and our lows. And when you pull back on a chart, and we'll do that in just a minute, when you pull out and look at a chart on like a yearly time frame, it's very easy to spot the institutional moves. Where are the banks moving money? And what we want to do as retail traders is we don't want to try and move money, we want to move with money. We want to get in line with smart money, institutional money, large hedge fund money. Okay, there's only 6 major banks or institutions that really drive price in the world, and we want to just ride those coattails. We don't want to try and buck the trend. We want to trade with the trend. We don't want to be where dumb money is, and that's the 90% of all of the retail traders that lose money in the market. We don't want to be a part of that group. Okay, we want to be a part of smart money. So we have our major points of reaction, and those are very easy to spot. Now we have our points of failure. Now this is our support and resistance on a lower time frame that has failed to reach these major levels. It's usually denoted by long wicks, but it's basically where traders have tried to push price either up or down and it has failed. And that's where we get our wicks from, is we see that price has tried to reach those levels one more time, but it has failed to reach them. And that's going to give us a lot of our support and resistance levels on our lower time frames. Okay, because if we look at a daily time frame candle chart, we will see candles with wicks, but those wicks are representing full body candles on lower time frames. Okay, it's going to be comprised of 6 4-hour candles, and then 24 1-hour candles, and so on and so forth. Okay, so as we go further down in our top-down analysis, we're going to see that we have our big institutional moves, our major moves, but we also have minor moves, and that's going to be That's going to be done on a smaller hedge fund level and on the retail level. Okay, so those are going to be showing up on our daily, our hourly, and our minute levels. Again, those are driven by smaller funds and our retail traders that are just doing those intraday, or swing trade movements on a much smaller time frame. Okay, so our points of reaction are our overall range. Okay, are they going to be our daily, our monthly, even our yearly levels that give us this massive range of price to move within. And then our points of failure are going to be our levels that are somewhere within that larger range that give us these smaller ranges to trade within. And then on a much smaller time frame, like the 15-minute, for instance, or even the 5-minute, those wicks then become our zones, our supply and demand zones that we use in our low time frame, like full circle scalping methods that we look for price to react at for much smaller movements. Okay. Now, there is no crystal ball in forex trading. There's nothing that's going to help you see the future of price, but these levels are our closest thing to a crystal ball. They are going to give us the best possible idea of where is price going to react at in the future, because they are psychological levels. They are a psychological representation of how far price has gone, and it's going to tell us that more than likely price isn't going to go beyond that in the future, because once it reaches that level, everybody remembers in the past that it didn't go any further than that, and so they're going to start taking positions against that level, and ergo it becomes a self-fulfilling prophecy. So by incorporating these levels into our trading, we can have a much better idea where we want to enter our trades in. So we're building off the idea of our market structure. Now we're looking at what drives that market structure. What creates these highs and these lows within that market structure. And now, even though this is extremely basic, again, this is one of the things that I see most traders throwing out the window right out of the gate. They learn major and minor levels, and then when it comes time to actually start trading, they pay no attention to it. They just get tunnel focused on their indicator that they're using, or on their channels, or on their Fibonacci, or what have you. And you have to remember, don't put the cart before the horse. Okay, in other words, don't just look at a trend line and think, okay, if it bounces off that trend line, I'm going to take an entry. Because as we move down, as we progress in this video series, this is why I have this module first, because we then integrate that with our other technical analysis. If price hits a level and a trend line at the same place, if we have that confluence, then we take a trade. Okay, then we have a high probability of a profitable trade, and we're not just guessing. So let me put this to you this way. Okay, I want you to choose one of these levels to trade from, and you tell me what makes more sense. Okay, we've got price coming in, we're in an uptrend, we've got our just most basic market structure, we've got higher highs and higher lows, so we know we're in an uptrend. Okay, now we have these different levels that we're looking at. Now we have this level, which has about a 60% probability of price reversing at. And we have another level which is 70%, 80%, and then we have one that has a 90% probability of price reversing at. So that means if you entered in on any of the other levels, it could reverse there, but it also has a 40, a 30, and a 20% probability that you're going to take a lot of drawdown before price actually does reverse. So which one are you going to trade off of? Okay, it's a no-brainer, right? I know it's very simple, but this is one of the biggest things I see traders just completely forgetting. And I know that we've all been guilty of it. We look at that 60, but then we get sidetracked by a trend line or a Fibonacci level or something, and we don't remember that there are larger levels that we want to be looking at and taking trades off of because we're so anxious to take a trade. So the answer is obviously the 90%. Okay? Because price is going to head up to that level, and more likely than all the rest of those levels reverse from that point. More than likely that's going to give us a major reaction. Now that doesn't mean that we won't get some type of reaction at the other levels, but more likely the scenario that's going to play out is that price is going to then, maybe drop a little bit and then keep going up and break back through that level and stop you out, and you're not going to get as nice or as large of a trade as if you play with these larger levels. Okay, does that make sense? Now let's take a look at this chart here. Okay, this is on the daily. This is looks like New Zealand dollar, Japanese yen daily. So we have price over here in the past, and this is great example because we're getting almost a double top. When we get like those double top levels, it really adds more strength to a level, because the more times that price is tested at a level, or sorry, the more times that a level is tested by price, the stronger that level is, because more psychological backing. It has more psychological backing because traders think if it tested once, it's strong, but if it gets tested twice or 3 times or 4 times, other traders and even institutions are going to think, okay, well, that thing is just not getting broken. And if it does get broken, it has to get broken in a major way. So we have this level of resistance up top that is supported by these candle bodies. And I always use a candle body when I set my level, but I like to get confluence by, or validation by, other wicks. Okay, so use the candle body to set the level. Use wicks. The more wick taps that you can get to a level, the more validation that yes, that level is a solid level. So we have this level of resistance up top, and then we have a level of support down here at the bottom. And this is on the daily. Now this is obviously an institutional move. I mean, look at how far this dropped over, looks like a good month or two. Okay, that's institutional money pushing that currency pair down. That's not retail money. Okay, does that make sense? And then all these little peaks and valleys in between here, that's retail and hedge fund money. Okay, that's smaller funds and smaller traders making those little ups and downs in between. Those are our minor levels of failure, because we have them pushing price down and it fails. It comes back up. They push it up, it fails. It never reaches this level again. It's constantly failing on its way down to this lower level. And then we get another push downward. Here's a little area of failure. We get this wick. It doesn't ever reach this level. So what happens? Price comes back up. Again, another level of failure here. Price comes back up and it hits this level exactly and reverses. So we have 3 major institutional moves here. We have this first big push down, then another big push back up, and then another big push down. This is institutions moving price, and everything in between is smaller hedge funds and retail traders trying to get their piece of that movement. So we want to trade with the institutions. When we see price about to reach this level, our ears should perk up and we should be getting ready to put in very large trades, because more likely than not, this level is going to hold, and these are the opportunities that we want to look for. Okay, if we're in a trend, if we're in a trend line or a counter trend line and we see these levels coming up, that's when we want to look for confluence in our trades. Okay, so what happens? Again, price reacts at this level and price reverses at this level. Okay, this is our crystal ball. These are what we need to be, these levels are what we need to be using going into the future trading, because these are the levels that we need to pay attention to. And I know it sounds very basic, but again, this is why I wanted to do this level or this video first, is because as basic as it sounds, this is one of the first things that people throw out the window when they start doing their trading. Okay, so let's take a look at an actual chart. Okay, so here on the Euro Canadian dollar, again, we start with our major levels. And you look here, we had a daily level, and what happens. It comes up and price fails to break this level right here. Fails to break this level and then continues on down and then starts to consolidate. We have that major level of resistance, and then we have down here major level of support. And everything in between is just a level of failure. It's just a minor reaction. Okay, let's make this a different color. Okay, and this is how I want you guys to mark up your charts. So we have major levels, and then we have minor levels that happen in between this range. And this is what I was talking about as far as all these levels of failure happen inside this range that's created by this daily high and this daily low, which would probably be also a weekly, maybe even a monthly high and low. Okay, so everything that happens within these levels is now a range, especially going forward from this point. Okay, so we have our major and minor levels. So we have another level here. Okay, price consolidated over here, and you just go through at a level here, here. We could say here. Actually, once it hit right there. Okay, see how this now we have. See how we have this reaction again here in the future, going from this level. We also had a reaction here. Small minor reactions, but when we trade, that's what we're trading to look for. We're looking for these minor reactions. Okay? So we have here again, and then price ping-ponged here until it broke through, came back up, and we have another level reaction here. And you can just go on and on and on setting these levels as you go forward. But what's the problem with that? We have another one about here. Okay, see how we had wick validate that later on in the future and then react. We have nice consolidation here. Wick reacts, price reacts. Okay, all of these movements. But we can see what the inherent problem is going forward is look at how messy this chart is. We have a million lines, a million different lines to choose from, and we don't need all of that when we start to trade. When we start to trade, what we're going to want to do is we're going to want to zoom out to the daily and look for these major levels here. Up top, up bottom. What's our major level? And keep an eye on that for when price comes to it. In the meantime, we want to look for very strong levels on the 4-hour and the 1-hour that are going to give us, as well as the daily for these minor moves, that are going to give us an idea of where we can expect price to react at that's relevant to price right now. And I talk about this in our full circle scalping room all the time, is that it doesn't matter if we have price, if we have this level up here, if price is down here. Okay, it's not relevant to us right now. Yeah, let's keep an eye on it for maybe way down the road, but as far as price is concerned, what we need to see is what's price doing right now. Okay, now if we zoom over here, look at that. Perfect tap right there. These levels are very, very valid. Look at this. This is happening right now. This is a weekend. Okay, so price isn't moving. As we can see, the markets are closed. But look at how we're getting a reaction on this daily level right now. Okay, so this is something we need to pay attention to as far as Euro Canadian dollar. We had price react, look, almost to the pip. We had these wick taps, and then once we had price break through, now we're looking at a possible uptrend. If we can get a rejection, maybe the market will open and gap up and then continue on upward. Okay, but this is what we need to pay attention to. And look, we have price reacting. This, of course, this is a daily chart, but we have price reacting. Look at this. This is from me just doing these levels way back in the past, but look at how price is still reacting. And now when I say that this gives us our market structure, This is what I mean, and this is what I want you to do on your markups that you're going to do for your homework. You set your levels and then show me how is price then reacting to create market structure. Okay, look at this. Here, here. Oh, that's perfect. A little bit of a pullback, goes back up. You know, it's not always going to be exact, but look at that. For the most part, it really is here. Okay, then we had price consolidate a little bit, come down. Okay, you see how this is making our market structure? Look at that perfect consolidation on that level. Okay, now we have our market structure. And again, market's not always going to be pretty. A lot of times market is going to be very ugly. You know, you're not going to get perfect head and shoulders every time. You're not going to get a perfect wedge every time. But you are going to get that very basic market structure. It just might look real ugly, but that's where you have to be able to differentiate between the ugliness and the patterns. Okay, the patterns are there. You just have to find them. Okay, and so we have our market structure within these levels of major support and resistance, and then minor failure, minor reactions. Okay, places where price, like we see here, price tried to break this level, it failed. It came up. It tried to close above this level, it consolidated, it finally did, came back down, failed again, failed at this level. Okay, broke through, but then came back up, failed at this level, came back up, failed. You see what I'm saying? This is why this is why I'm referring to it as points of failure, because that's where retail traders and smaller funds are failing to push price beyond a certain level that has already been established in the past. And that's where we want to take our trades. Okay, I don't want to jump too far ahead, okay, but if we set a trend line here based off of just this, oops, forgive me. Okay, if we take this box here, this trend line, this wick and this wick, so this failure, this and this, and we take a trend line out into the future, look at how it intersects with this level almost perfectly. Now if we were to just look at it on its own, taking just a trend line bounce is very risky. But we know we're in an uptrend, and when we get this trend line to interact with this level, now we have a solid trade. And if you would have taken that trade, it went up for a nice 625 pips if you wanted to swing trade that out for a week, because those are our high probability setups. Okay? So I hope that makes sense. I don't want to make these videos too long. I'm just going to give you this, information in these big bursts, but that's why I want you to go back and watch these videos a couple times and really let the concept of these levels, these major and minor levels of support and resistance sink in. And trust me, we'll be doing these all the way through the rest of this module. I just want to get a foundation of this knowledge first, and we'll build off this as we go into our next videos. Okay? So let's talk about your homework. I want you to watch this video 5 times. I want you to mark up 5 charts showing me major levels of reaction. Okay, that was those green levels like on the daily time frame that price never got above or never got below. Then I want you to mark up 5 charts showing me minor levels of failure. And again, I want you to put those on candle bodies, but then I want it to be validated by at least 2 or maybe 3 wick touches later on in the future or in the past that validate that level. So your charts are going to be very messy. They're going to have a ton of levels on them, and that's fine. We're not using those charts for trading. I just want to know that you have the concept of levels down, of major and minor levels of reaction and failure. Okay, and then within those charts, I want you to then mark up the market structure as I did there in the very end, as I just did, about 5 minutes ago, and show me how now those levels make price react and form our higher highs, our higher lows, our lower highs, and our lower lows. Okay? And you're seeing how it's starting to all come together where we're getting market structure within levels, and then that's going to show us where we're going to want to start looking for trades at in the future. All right, guys, send me all of your charts for review in the Telegram channel, and I will check them over, and once I give you the thumbs up, then you're ready to move on to video 3. All right, guys, thanks for joining me in this module. I look forward to seeing you in video number 3, and until then, I'll see you in the charts.